I'm Julie Farrell with Director's Mortgage, and I've got the one, the only, Brent Bishop from CIS here with me. And I think for most of my partners, clients, the whole world, they don't know who CIS is, but in lending, CIS is a very big deal. And that is our credit provider. And so what Brent has been for me for the last 20 years in this business is a tremendous resource for all things credit related. So questions that I've got, a resource for my consumers, helping clients map out how they can best reach their objectives. And so I wanted to bring him in today to just kind of talk about some of the more common questions that I get on a regular basis with credit and where that's concerned. And then I've also got Marissa, my assistant. If you've ever worked with me before, Marissa's most likely asked you for something, an appointment time or documentation.
And if you didn't get it to me, I probably really annoyed you, sorry.
But she's very good at what she does, and I very much appreciate her. And I brought Marissa in to sort of be a good sampling of questions for those that maybe aren't as involved in the the day-to-day traffic of credit and underwriting. Marissa helps me out on business development. Oh, Robert, don't you dare leave. Because, so I'm about to introduce Robert, who I've only learned today is Robbie now. I feel like I don't even know who this is. And he is the gentleman that works in our marketing department that sets up all these great cameras and sound and lighting and helped warm it up today. Thank you, Robbie. But he had great questions for Brent as we were setting up.
Right. So first of all, thanks for the introduction. This is fantastic. Yeah, Julie and I go way back. I've done this for Robbie and I were talking about 29, working on my 30th year in credit reporting, well before credit scores were even a thing or used in the mortgage industry. So I watched all of that development. And some of the first questions that Julie had for me and that we were going to go over was, what does a average consumer, or what are the most common questions to get with credit reporting? Well, while Julie and Marissa were running around doing presentation, we should have been, Robbie and I should have been recording, because he asked what I did.
These are the questions that people want to know.
But these are the questions people want to know, and I said, well, then we can change this and we can bring Robbie in. So Robbie's going to come up here with us and ask some of these, start out by asking some of these some of the basic questions that he asked me before, and I'm gonna do my best to answer them. And Robbie was concerned about noise, but we've covered that now.
Perfect.
So,
well, welcome, Robbie. Robbie's part of our marketing department, and he does a bang-up job.
Behind the camera.
So
now my face might break the camera if I'm in front of it.
No.
we got this. No, we got this. So go ahead and ask. Well, you told me that you're new homeowner.
Yeah, we just bought a home in March.
And so,
we just leased a vehicle in July, and then we bought a vehicle in 2 or 3 months ago. We have one credit card, and I was like, how do I get my credit score up? That's kind of one of my things. How do student loans come into play? That's also another factor. And you gave me a ton of great advice.
You're totally right. That hits on all the questions I was going to ask you.
Pretty much.
I don't even know what we're doing here.
All
right, bye guys.
And now they're all rapid fire. Before he asked me one at a time. Now I got to go. I'll have to piece all through this.
Well, I've got them listed out here. He didn't go in the same order, but they're pretty close.
But so one of the things that we're going to eventually talk about were what are myths, and one of them, it's not really a myth, but he mentioned to me that that after you get a home loan, that your credit score is going to immediately skyrocket. Well, while a home loan and a 10-year mortgage loan paid for a long period of time is one of the greatest anchors that you'll ever have for your credit score. It shows that you have the propensity to pay a very large payment over a committed period of time. And that's what the formula is looking at in all 5 of its categories. You mentioned that you got a lease and that you have a bunch of student loans. All of those are installment debt, which ironically is but that's one of the questions that she was going to have me talk about, is what's the difference between installment, what's the difference between revolving debt. The lease is, again, it's a fixed number of payments over a fixed period of time, and when that's done, that loan is considered closed or paid, and that history, while it will still stick with an individual's credit for a period of time, 7 years, after that, the further it gets out in time, the less it will affect the score in a positive way. The other type of credit is revolving, and he was talking about, revolving credit is where you can influence your score probably the most in the shortest period of time. And he talked about having a Home Depot card because they were going to go buy all their new appliances for their home, and they immediately maxed it out. And he probably does some type of credit monitoring service. Maybe it's through Credit Karma.
Hey, how'd you
Is
know?
that well? Because that's probably one of the most commonly. It's probably one of the most common ones, and it's a great.
It's a great measuring tool.
It's a great measuring tool. Now recognize that the scores that you get, this is also an important factor, but the scores that you're going to see on Credit Karma are not going to be related exactly to the mortgage score. We can get into this later, but just in a quick nutshell, the mortgage scores that we use today, they're actually very old. This is due to the industry needing to understand what their default ratios are and how they price their loans. And if they use some of the newer models, they won't have all of this analytical data to make good lending decisions. That's really the nutshell version. But help me, where was I going with this? I'm talking about revolving credit.
Yeah, well, okay, so you are going so fast through so much information. I'm pretty sure everybody is going to be like, wait, this relates to me in every way. This is everyone. And so I think we've got to slow down.
Okay.
And start from the beginning with types of credit. So there's installment debt, which is your fixed monthly payment.
Right.
It stays the same for the duration of the loan amount, whether it's 3 years, 5 years, 30 years.
Right.
There's revolving credit.
So let's focus on revolving debt, because that's really where I was trying to go anyway. Thanks for getting me back on track, Julie. So we'll keep going with this. So the revolving debt.
Off we go.
Revolving debt, basically, it fits in a category that considers your proportion of revolving debt to high credit limits. It also considers this on your installment loans, but that 30% of the formula on your credit score is more heavily weighted in revolving. And the reason I said it earlier is the way that you can affect your credit score more with revolving debt is if you can control your proportion of balance to high credit limit in certain sectors, it will artificially or can artificially affect your credit score. So when Robbie says,
let's give him an example.
So Robbie says that he went out and he charged up all his, he charged his credit card up, the only one that he has, and he charged it up to the max. Well, when he was on Credit Karma, he saw that his score basically plummeted, maybe as much as 50 or 60 points, could have, due to the proportion of revolving debt to high credit limit. Now, then he said, no, now we got it paid down, and it's at about 50%. Well, the way Credit Karma works is it's monitored every month, where you can probably log in and see any given day. And when this new data gets reported to the repositories, the formula is now calculating based off the new proportion of revolving debt to high credit, and not the old one. So it's like taking a picture. So credit scores are determined, whatever data set exists at the time that credit is pulled, it calculates it right then at that time. Now, what I talked to him about then too is he said, well, I thought 30% is my next goal. And I said, yeah, but probably try to get below 25% actually, because it's these aren't disclosed to people. These are through the analytics.
I think you have to even go further, because maybe Robert knows about this, but I think for the average person, the goal should be to keep your balance. If you've got a $1,000 high balance credit card or $1,000 credit limit card, you want to keep that balance based off of what Brent is saying here at $250 to ultimately yield you the best scoring possible. Is that right?
It's right, and that's in the right direction, and where I was going about why you'd want to be below 25%. Ideally, what you want to be is below 10% and not to zero.
Really?
Yes.
I thought it was just below 25.
Well, that's a huge barrier point, and you are correct. But you want to. And what I was going to get at is, it's always been said, well, at 80%, and then 50%, and then some people said 30%. What we've really figured out over time is that the real super magic number is to below 10% and not to zero. Everybody thinks, I want to go out and pay off all my credit cards. Well, if you pay them to zero, then you're showing no credit usage. So the formula applauds and likes the responsible use of credit. but it wants that it considers the super responsible to be below 10% of the high credit limit and not to zero.
Okay.
Now, with that said, there's a thing called your statement balance, because you ask, well, if I always have to carry a $10 balance or 10% balance, well, then I have to pay interest on my credit card each month, and I don't want to pay interest. Well, that's not true. What you would do in the analogy of a $1,000 high credit card, if you went to, if you charged up to $100, then you waited for your statement date. The balance that gets reported is the date that your statement cuts. So for me, my credit card cuts on the 24th. So by about the 25th or the 26th, that's when that whatever balance that was is going to show up. So if I wanted to make sure that it was going to score me as high as possible, if I had charged over that amount prior to my statement date, I could actually pay it down to below 10%. And then once that cycles through, 3 days later, we can pull your credit report again, and it will bounce. It will be reflective of what the balance was on your statement date as it gets reported to the bureaus. The thing to recognize in consumers, and Marissa and I probably have to do this more in our rescore department, so when we're working on trying to get somebody's credit score up, it's really important to understand when the credit cards actually report, because you could actually get your consumer, and this would be great for, let's say somebody, a client's getting ready and they're shopping for a home, but they haven't even made an offer yet. And so you've probably got 30 to maybe 2 months before anything happens. Well, you could have the consumer say, I want you to pay all 3 of your credit cards down to below 10% of the high credit limit prior to your statement date. And when you tell me that that's happened and all those credit cards have cycled through, that's when we're going to pull your credit. It's because you're going to maximize that number, and then you're going to put Julie in a great position to offer better interest rates and all this other type of stuff.
It's all the client doing the work. I'm helping map that out for them in advance of them making an offer, and that is genuinely one of the benefits about working with myself and Director's Mortgage is we have these services available with Brent to where Marissa can work with Brent and formulate this whole roadmap to either get you to a better position to purchase so that you can qualify for the best terms and pricing, or get you into a position to where you qualify if you didn't previously. And if you don't want to take the information, there's no obligation, we truly believe in just educating and serving, and so it's really fun to see consumers follow these roadmaps, especially the ones that put in a tremendous amount of work, and then see them come to their goals in 6 months, 9 months, or even faster. Sometimes it's really fast.
It can happen really fast depending on the balance of the credit profile. And the other thing too, to add to what Julie's saying, is that not only is it a benefit, her primary goal is to get you a home loan, but those consumers that work with Julie and Marissa on a daily basis, they're going to be more prepared for all of life. Credit reporting is affecting.
Sorry to laugh at that.
No, but in the credit world, well, I know it depends on what.
Really
depends
big
on what.
statement.
I'm talking about the credit world side.
Okay.
Because credit affects. It's going to affect your insurance rates. It's going to affect your credit card rates. It's going to affect. It can technically affect your auto insurance. So having a good credit score across all walks of life is going to help you financially, not just for getting your mortgage, but it's going to help solidify. It's going to make your next car loan cheaper, because you're going to go in there and you're going to have a 800, and you're going to get the best. You're going to get premium financing from that too. So those pieces of education are going to carry along for many more aspects of an individual's life than just going for a mortgage.
Okay. Well, way to make me
You'll
feel a
take
little
that
bit
better.
better.
You were
about
worried
all
that
of
you were
this.
going to.
I am not responsible for
No.
all of this, but
Only the
no,
credit
it does
side.
trickle down.
It trickles down.
And this is a non-threatening, easy way to get good information and to put together a plan. And it's a plan that actually works. And there's no cost for this plan, which I keep hitting on, because I'm not a credit provider. You are, right? I can say that?
Yep.
Okay. Brent's a credit provider.
We're a credit provider.
Okay. So we've
UCIS is, but yes.
we've hit on a couple of the most common questions. I feel like we're going to hit on more. We've talked about the types of credit, installment and revolving. Are there other types of credit?
Well, there's what's called a net 30, and those are, the primary one that used to be there was American Express cards. What that means, a net 30 account is that you you charge up as much as you want to charge, but it's required to be paid in full at the end of every month. Those are, I don't even want to try to discuss how complicated those are to try to figure out how they're calculating in the score, and I don't think we need to go there. Also, a lot of American Express cards, they've really moved to revolving now as well, and that's because they had to compete with Visa and MasterCard, because not everybody makes enough money to charge up whatever they want and then pay it off in full every month. And many do, but if you don't, again, we want to always keep trying to focus towards getting down to that below 10% of the high credit limit,
Sure.
not to zero, and showing usage every month.
So, Marissa's writing a question.
Please continue. Ignore me. I'm just doing my thing over here.
So, one of the things that I'm seeing happen more frequently now are consumers having their utilities report on their credit reports to try and build credit. And I don't think that very many people know that that's even an option for building credit. And so if you have zero credit, if you come from a long line of cash only and you're trying to get started in that space, what are the perils and pitfalls of setting up utilities to report, and what are the benefits, I guess?
Okay, so...
And I didn't prepare you for this one. Sorry,
what
curveball.
what Julie's primarily referring to is there's a product out by Experian. It's called Boost, and they're called self-reported trade lines. You can report your utilities. You can report your cell phone bill, which typically won't. You could report your gas card. Well, I don't know if you can do your gas card or not, but whatever so you can go and add these. Now, the pitfalls is that the scoring models that we use in mortgage, and so this is specific to mortgage, do not take those types of trade lines into the score calculation. So they don't take them into effect. So basically, even though you added these 3 good trade lines, when the picture's taken, so to speak, and you pull credit, the scoring formulas that we use in the mortgage industry do not calculate those new self-reported utilities. The scoring models that do are a little bit newer, and so that would be anything from a FICO 9 and higher would be, those would calculate their score. Now that might be the auto industry that does that. That might be a credit card company that's using that. So it's not to say that those self-reported trade lines won't work for some of your creditors. What I can tell you is that the majority of loans that are sold are done through Fannie Mae or Freddie Mac, and then ultimately those get sold off to other servicers. I spoke about default ratio before. They're very comfortable with the old formulas that they use because they have a long history of recognizing how to price based off of certain scoring subsets. And when you start throwing in all these new trade lines and artificially changing the number, it will maybe throw somebody that shouldn't be qualified or shouldn't be qualified at the rate you're qualifying them for because you're artificially improving their credit score based on a different criteria and model. And so some underwriters, and it took a while, this is kind of evolving in the industry right now, or a pain for Julie is if our underwriters say, well, you got to have your borrower remove all of those because they think it is going to affect the credit score.
Well, I got good news there. So, we don't look at it. I thought it really did impact the scoring. So this is good for me to learn this as well. But we back out that monthly payment, so it's not considered a liability in terms of debt to income ratio qualifications, because those are, we presume everyone has a cell phone bill, everyone has an electric bill, everyone has whatever it is that's reporting.
What about rental, like first time buyers who are like, hey, I pay rent every month on time for the last 10 years. Does this benefit me in a positive way?
It does now, but it's a little bit of an unrelated question because typically rental payments don't factor into credit reporting unless you're delinquent. But sidebar away from credit reporting is that now there was an update to Fannie Mae's underwriting system September 19th, because I get real technical like that. And they have changed it to now that they will look at your rental history and factor that into your propensity to make a mortgage payment, and it can be a factor to approving you from an ineligible if you have a good reflective.
Great for first-time buyers.
It can be, for sure. Wow. Yeah.
And Julie made an important distinction here. The mortgage rating itself is not going to have any bearing on credit score. What the mortgage rating is doing is allowing for a different, maybe a little bit more leniency in an approval on a positive way from her underwriting side, not from the credit scoring side. But
and
that's
rental payments.
specific,
Yep.
and so and it won't happen in every file, but it does give a little bit more playing room if she finds her.
For sure, but a great point to bring up, and one that
People probably
absolutely
ask.
needs to be distinguished and out there, because it can help people. If you've got good payment history, I mean, honestly, mortgage lending is like a bar stool. If you've got 3 legs, you can stand up on it. And the legs are collateral, the home that you're lending against, credit, income, and assets. So if you've got 3 strong factors of those 4, there's typically a way that lending can happen.
Yes, agreed.
I like metaphors.
I do too. That's a good one. I'm with it. And I like the 3-legged chair. That's what, and that is what it is. You're right. I mean,
It is. It's
all
the
that
4
matters.
things.
That's awesome.
So it's a good thing they don't all rely on credit reporting. But
No.
So let's talk about disputed accounts, because that's a great segue.
Hey, no problem.
okay, yeah, I'm disputing that comment about 3-bud also.
Way for me to, just bring it down. But disputed accounts. I get clients that run into this often. They've got something on their credit report that wasn't factual. They dispute it. And from a lending perspective, I can't have any of that. You've
Yep.
got to take it out of dispute. And what that does is as far as I understand it, so when a consumer disputes an account, a trade line, that trade line then basically becomes numb to their credit score. It's a non-factor.
That's a good way to put it.
And then when they remove that dispute, all of a sudden it can be a factor in their score, and not
Yes.
often to the positive.
Yes, everything Julie said is absolutely true. And the reason being, there's a little nuance that's tough to get around. Not all disputed trade items are being omitted from score calculation. She said num, but I'm going to use omitted. They're the same synonym to each other. And so if they're being omitted from score calculation, typically the items that you would dispute on a credit report would be the negative ones. So if you omit all the negative ones, there used to be a form of credit fraud where they'd say, well, oh yeah, go out and dispute all of these. And then once they're all in dispute, they'll dispute all their negative ones. And then the loan officer would repull the new credit report, and it would only pull on the 2 good ones, and their credit score would jump up from the 620 and it'd jump up into the 740s. Well, that basically was, well, then what do you think happened? Well, a lot of those loans went default, and so Fannie Mae and Freddie Mac figured out that that's not going to work out for us very well, and they changed their guidelines. Those guidelines now require that all those disputed items the notation of the dispute remark be removed, and credit needs to be repulled, thus giving the underwriter a true representation of what that consumer's credit report is, with all their negative which with all those other negative was now being calculated in. So when Julie might pull a credit report and it's got 3 disputed items on it, fully qualified, you remove those items and she has to repull. Now all of a sudden you're sunk and you have a non-qualifying borrower. And then at that point, Marissa and I start scratching our head, and we actually all do. We figure out what other debt we can have them pay
I'm
off,
there too.
and how
That's
do we
right.
get? I know we are. And how do we? But I mean, how do we? But then how do we? So then now, how do we get around that?
What's
or
the plan?
what's the next option? And that's all you can do. And so yes, disputed accounts can wreak havoc in Julie's world.
Yes, they can. Yes, they can.
Yes, they can.
Yes, and I feel like the next thing that I have to bring up that I didn't warn you about was forbearance, because obviously we're in a space where a lot of consumers have taken the opportunity to do forbearance because they needed it, and it was a great solution. 80% of Americans are out of forbearance that they've gotten into, which I don't think a lot of people understand that either, that it was really a useful solution to a lot of consumers. And so from a credit perspective, I know that if if a borrower who has a mortgage applied for and was approved for forbearance, it wasn't reporting to the credit bureaus that they were not making payments.
Yeah.
I feel like you've got feelings on that.
Well, it's complicated because when this originally started, yes, the idea is that a borrower wouldn't be penalized for having an account go into forbearance. Forbearance is essentially the same as the creditors agreeing to, for a time period, settle for less than the prescribed amount of the contract, and so they are not meeting the obligation of the contract, and so therefore the creditors, many of them, and they did what they wanted, and they said, well, they are not meeting the, we'll absolutely allow them to go into forbearance, and we're certainly going to let them take, we'll take less payment for the period of time, but we're still going to report it as if it's going to affect their credit because we are settling for less than the full amount. And so some took it that way, some did not report negative. So what I'm going to say on a forbearance situation is that Julie's going to have to look at everyone almost on an individual basis to determine where are we at. There's probably going to be some requirements that in order for her to refinance or to sell, they're probably going to have to get the home back fully up to the right amount of payments amounts and out of forbearance.
Absolutely.
And then she has an option to refi.
But
And
what's great about it is that, I mean, equity positions are phenomenal.
good
We're
point.
what, 19.8% above last year at this
Right.
time, and same
Yeah,
for the year
right,
before.
right.
Like, equity gains have absolutely nullified all of the tsunami of foreclosures that were expected at the end of this. Because if people aren't able to get out of forbearance, maybe they can't make their payments, they have the option to sell, and they'll likely sell, even if they did 100% financing, they'll likely sell and still make money without having made their payments for the last 12 to 18 months. I mean, like, the numbers are just crazy. And so thankfully the outlook on that scope of things is very small. There's a finite amount of foreclosures that are expected with the moratorium of forbearance coming to an end. But what most consumers are given the option of with their servicer is either to take that arrearage, so the missed payments, principal and interest, the missed escrow payments, and tack it on to the end in a silent second, and then just take on their previous mortgage payment. Like, that's the scenario that I'm seeing most often played out, because they already qualified for that payment. If they're back at work, they should be able to still make that payment, and then the arrearage just gets tacked on to the end because there's enough equity to cover it. So most Americans are just kind of going back to what it was before COVID, which is fantastic. So next question.
Yep.
Credit myths. What's the biggest credit myth that you get to dispel on a regular basis?
Oh, God.
That's a good question.
Well,
We're listening, Sensei.
I don't know. I mean, currently there's a myth going on that there's a company basically that is suggesting that they can get your rental piece reported to the repositories and that will affect score. Just like we were talking about earlier, that might be true in the higher up versions or the more recent versions of the scoring model, like FICO 9, but scoring models for the mortgage industry, I mean, we're on Beacon 5 for Equifax, we're on FICO 2 for Experian, and we're on Classic 04, all of which are like Classic 04, which means
Like DOS based.
that's like 2004, and
Yeah.
we're in 2021. So we're talking old. And that
Or
those
refined.
those reported, even if you go through the process of getting that to report, it isn't going to affect your mortgage score. It might affect some others. And there's a company out, and I'm not going to throw any dirt or say their name, but the claims they're making are true, and it will not affect your mortgage score. So
Whew.
that will leave that.
That's
Now,
a big, heavy one right there. Look at that.
yeah, and I don't know myths. I mean, you probably have a myth in your mind. What do you want to
I
ask?
don't even know if it's a myth, though, if it's in my mind.
Well, okay, it's true.
I
don't
just
know.
need to spend more time talking to you, Brent. I've learned a great deal here today
Oh, well,
already.
thank you, Julie. The
Is
main
there
thing-
anything else that you feel?
I
that-
mean, I think this sounds so basic, but I think the most important thing that you need to think about is you need to think about having varied aspects of credit. So you need installment loan, you need a revolving loan, and home loan is great for longevity. It's fine to have a car loan. You need to always make your payments on time, regardless of what it is. That's going to be the biggest dropper in your credit score. I think you need to recognize that the longer you have these accounts, the higher and higher the potential for your score to go is. And the bigger, here's a myth right here. Inquiries are not nearly as impacting on your credit score as you think. This is the best myth.
Thank
Do
you,
not be
Brent.
afraid of an inquiry.
Do not.
First of all, it's only 10% of the overall scoring formula, and it is almost so, and especially for a person with really good credit. The impact of a mortgage inquiry for somebody, and for me, or I have good credit.
Oh, yeah?
Imagine that.
Good for you.
Yay.
But it's going to be it might drop my score 2 points, and which is not going to matter because you're going to still fall within great parameters of getting a loan.
Right.
Now, if you're an individual that has recent derogatory, you have all your credit cards maxed out, and now you're out applying for credit, the formula looks at that and says, I don't like this. This is risky. This person is already delinquent. They've got everything maxed out, and they're about ready to go default anyway. So that inquiry can take a few more points off. Now, in the first 30 days, though, the inquiry that's pulled will not have any bearing on the individual score at all. It's after 30 days that it will start to have an effect. So the day that Julie pulls credit, she's working with the score that she's going to go with to underwriting, as long as there's not a whole bunch of other crazy things that happen, which can. So be prepared. Well, and I mean, be prepared that if your credit
Mortgage
score
crazy
is
stuff?
not good,
No.
you know that
Never.
we might have to recalibrate based on some of the things that we talked about with the disputed items, with needing to get credit scores
I
up,
was
etc.
saying that we were close to wrapping up, but we're not,
No.
because there is a credit refresh that happens right before closing that I don't think very many people know about. It's not an inquiry for credit. It's a refresh credit report on that original inquiry credit. And what it does and why we pull it is to make sure that no new credit has been obtained during that application process, to make sure we've got a full scope of that liability load. Because unfortunately, there were some folks that realized they could apply for loans simultaneously, and we wouldn't know about the
Uh-oh.
other loans, and
Right.
it created some bad scenarios for people. Anyway,
And-
it's not it's not a hard pull. It doesn't
Right.
affect scores.
We call it a refresh report. It was basically the LQI compliance. It's a loan quality initiative compliance that brought this about. And the reason that loan quality initiative compliance came about is exactly what Julie said, is they figured that, well, I can go get 2 loans simultaneously, probably on the same piece of property. They bank the $300,000 loan that they got, and the other one's paid off, and another form of credit fraud. Fannie and Freddie says we can't put ourselves in that position, and neither would the lenders. So the way that they do that is a credit report 3-5 days prior to closing, something like
Right.
that. Julie would know more than that when it's
3
pulled than I
business
would.
days.
3 business days. And it's exactly that, is they want to see, are there any new inquiries, and is there any new debt? And if there is, they might have to rework the whole loan to
Yes.
then requalify
And-
you. So,
Yeah.
another point, and Julie will.
Yeah, we're gonna
do
tell.
not-
Yes.
We are not even close to
do
done.
not buy
I think of
anything.
so
Do
many
not
things.
change anything regarding your credit
Please,
report. Do not
don't
apply.
change.
Don't buy. Don't go
get
buy your
the
furniture.
appliances at
Don't
Home
get your-
Depot like
Buy
Robbie.
cars.
Don't be Robbie.
Good example. Hate to throw him under the bus, but don't do
I
that.
love Robbie,
He's
but
gone.
don't be
It's okay.
I
Robbie.
think he
He's
did
gone
it
now.
afterwards to give him credit, but but yeah.
Seriously.
No,
It
no,
happens all the time.
auto-
when
It
we're
does
in the middle of the
happen.
loan.
It does.
Stop buying the cars.
Don't buy
Darn
a
it.
car. Don't
Well,
apply for
the-
the 10% off at Target. And because it all shows up, and here's where it gets really tough, and you may not even know this part, is that when those new liabilities come up on my side of things, I now have to show the note. Well, when you apply for new credit at the cash register at Target, do you know how to get your note quickly?
No.
No.
Have fun with the
Well,
800 number.
Well,
Right.
the other thing too is, even if you're a high income earner and you buy that car and you think, well, it's no big deal, I know I've got enough money to pay for this, or you just know that it's not going to necessarily keep you from getting a home, I believe that you all have to go through a whole bunch of brand new paperwork. You have to
The note.
you have to
The same thing.
you have to
Yeah.
redisclose everything. You have to recalibrate. You have to redo automated underwriting.
We may not
So
have to
they
redisclose, but we've got to figure
Oh.
out whether or not they
can
qualify,
still qualify again.
with that new payment.
Bottom line
And
is,
honest to goodness, it's getting the note
It's
and the
just-
terms of that new loan that provide the most challenge. Sometimes
Okay.
people will no longer qualify. That's not typical.
Okay.
Because I really do a hard nosed job of making sure at the consultation level that people know do not apply for more credit.
Right.
But they will apply for the credit for the appliance to get the discount on the furniture, all the
Right.
things, and it totally makes sense. Just please call me or your lender
Yeah.
beforehand, because
ask first.
So, the only other thing after that, and it was part of where I was before, is of the 5 pieces of the puzzle, the proportion of revolving debt to high credit limit. That goes in with the length of time. And one other final myth: length of time accounts established. Another, not necessarily a myth, but some people believe that if you close all your credit cards, you're going to improve your credit score because you have no more. This is absolutely false. When you start closing, when you start closing your credit cards, what you're doing is you're shortening the length of account history. 15% of the credit formula is based on the length of account history. And in fact, credit cards they're starting to receive maximum point value for any given credit card once it hits 4 years. That increases in increment after the first year, the second year, the third year, and the fourth. So if you go out and close a credit card that's over 4 years old, you are potentially taking a big. Now, if you got multiples over 4 years old, you're fine. But if that's your oldest credit card, I guarantee you're dropping your score if you
Brent,
close that account.
we just don't close anything over 4 years. That hurts my heart to even
Don't.
think about. Just don't. Please
Don't do it. Don't do it. And and if you do want to close one because it's got an annual monthly payment that's kind of nagging at you, make sure that you got 2 or 3 other credit cards over 4 years old before you close that other one, because the balance of the formula, it's right there, and it wants to see length of account history. So don't close your credit cards. The other reason is there's 2 parts of the formula on your revolving accounts. There's an overall credit profile, proportion of revolving debt to high credit, and there is a line item by line item, meaning credit card by credit card portion of that. So even if you're not using a credit card, you're helping increase or decrease your proportion of revolving debt to high credit limit on the overall pro forma, and you're not having any negative effect on the individual
Yeah, I like that.
forma.
Yeah. Well,
Thanks for having me. You two are fantastic.
We
Appreciate you
are.
both.
Well, you are
Thank
too.
you.
Thank you.